Hey guys, welcome back to the channel. Today I'll be sharing with you my stock portfolio, which mainly consists of high growth stocks that I believe have the potential to generate multi-bagger returns in the next few years. So these are stocks that I've talked about or written about at X, Seeking Alpha, and YouTube. So I'm putting my money where my mouth is. So in today's video, I will briefly talk about the stocks in my portfolio, what my allocations are, and why I own each of those stocks. In addition, I highly encourage you to check out my Seeking Alpha page where I publish my full research and analysis on each of the stocks that I will be mentioning today. So I will leave the link in the description box below. And with that out of the way, let's take a look at my portfolio. So I'm using Savvy Trader to keep track of my portfolio, and I literally just set this up an hour ago. So you can't really see the performance of my portfolio, but it'll be really interesting to see how this portfolio performs in the future. So don't forget to subscribe if you want to track along. And keep in mind that this portfolio is not available to the public yet, but I intend to make it public at some point in the future so you can get real-time updates on my portfolio and any trades that I make. However, you do have to be a paying subscriber to access all these features. But for now, this portfolio is still private, but I'll keep you guys posted. Now, for the moment that you guys have been waiting for, what do I own in my portfolio? As you can see, I have 13 positions in my portfolio, so it's pretty concentrated. But let's start with the smallest position and work our way up. So the first stock in my portfolio is Enphase, ticker symbol ENPH, which make up only 1.35% of my portfolio. So Enphase is a solar company, and what the company does is that they sell smart home solar energy systems, which consist of microinverters, batteries for energy storage, and other accessories like EV chargers. So if we look at finchat.io, which is a financial research platform that I've been using more and more these days, we can see that the stock is down nearly 70% from its all-time highs. But why is the stock down so much? Well, the solar industry is facing a lot of headwinds currently due to high interest rates, which make purchases for solar equipment relatively expensive compared to a few years ago where interest rates were basically zero. And because of that, solar demand fell and sales declined, which caused solar players like Enphase to sell off. But over the last few quarters, we are seeing some stabilization in the solar industry, and I believe these next few quarters, we will start to see a recovery in demand and therefore a recovery in Enphase's fundamentals. So while the fundamentals have been really poor over the last few quarters, I think the headwinds in the solar industry is temporary, and I believe the long-term outlook remains favorable for Enphase. With that being said, the reason why I'm bullish on Enphase is because the stock is still down 70% from its all-time highs, so valuation looks quite attractive here. Another reason will be that the company has industry-leading gross margins at 46.36% and a free cash flow margin of 22.12%. And the company also has a very high ROIC of 48.3%, which is really great. And also, rate cuts are on the horizon, and I think that will be a major catalyst for the stock moving forward. So I do have a price target of $160 a share for Enphase stock, which is about a 50% upside based on the current price of $104 a share. That said, I do think Enphase is a very risky stock, which is why my allocation is pretty low at just 1.35% of my portfolio. Moving on to the next stock in my portfolio, we have Lululemon, ticker symbol LULU, which represents 2.34% of my portfolio. I think you all are familiar with the Lululemon brand, which is probably the most popular yoga-inspired active clothing brand in the world. Now, I recently wrote a deep dive article on Lululemon where I highlight the 10 reasons why I'm bullish on Lululemon stock. So if you're interested, you can find the link to that article in the description box below. But just to give you guys a quick summary, one of the reasons why I like Lululemon stock is that just like Enphase, they have industry-leading gross margins of 58.34% and very high ROIC of 33.48%. And these are much higher than bigger peers like Nike and Adidas. But the major reason why I have Lululemon stock in my portfolio is that valuation looks much more reasonable at current prices following the stock sell off of more than 40% over the last 7 months. And you guys might be wondering, why is the stock down so much? Well, I think that's because growth is slowing down and the company also gave soft guidance that doesn't really inspire confidence in the markets. So you can see in the growth column right here, Lululemon has been growing revenue at a 3-year CAGR of 25% and a 5-year CAGR of 23%. However, in the next 2 years, analysts only expect Lululemon to grow by 11%. And we can also see the same thing for earnings per share. The company has been growing earnings per share at a 3-year CAGR of 32% and a 5-year CAGR of 26%. However, in the next 2 years, analysts only expect a 2-year CAGR growth of 11.75%, which is quite a slowdown from recent years. So I think the growth slowdown is scaring a lot of investors, which is why the stock is down so much. However, I think Lululemon has a strong brand moat, and I think the company still has a long growth runway ahead, especially in international markets and other sports categories like running, tennis, golf, and more. And let's not forget, the company is highly profitable with a net income margin of 16% and a free cash flow margin of 17.6%. PE ratio is at 22 times, and while that is not cheap by any means, we can see that its PE ratio of 22 times is at the lowest it has ever been for the company over the last 10 years. In other words, valuation multiple is at a 10-year low, which is why I think it's a good idea to load up on the stock right now. So my price target for Lululemon is $412 a share, which is about a 40% upside from its current share price of $285 a share. I just started a position in Lululemon about a week ago, and it's only 2.34% of my portfolio currently, but given the opportunity, I will make this a much larger position. So the next stock in my list is C Limited, ticker symbol SE, which represents 3.95% of my portfolio. So in a nutshell, C Limited is a Singaporean-based tech conglomerate that owns three businesses, namely the mobile game developer Garena, the e-commerce company Shopee, as well as the fintech unit C Money. And so one of the main reasons why I own C Limited is because the company has very strong competitive advantages. For example, Garena owns some of the most successful and most downloaded mobile games in the world, including Free Fire and Call of Duty Mobile. In addition, Shopee also has a strong brand, cost advantage, and efficient scale modes in Southeast Asia and has an e-commerce market share of nearly 50% in the region. Now, Southeast Asia is a fast growing region with increasing adoption in e commerce and fintech, so the growth in the region will be a massive tailwind for C Limited, especially considering its leadership position in Southeast Asia. The major risk here is competition and whether Shopee will be able to sustain its leadership position in the region. But I think competition is nothing new here. I mean, I'm Indonesian and I often travel to other parts of Southeast Asia, and the only thing that I see is that C Limited or Shopee continues to dominate in the region, even despite competition like Lazada, which is owned by Alibaba, as well as Tokopedia, which is owned by the Goto Group. So as you can see, this chart shows Shopee's e-commerce revenue over the last few quarters and years, which has consistently grown by high double digits, as you can see right here. And recently, growth has actually re-accelerated. So that speaks a lot about the company's moats and strong execution, and I think Shopee will continue to dominate in the long run. That being said, C Limited has to go over another hurdle, which is to improve profitability. As you can see, the company is basically operating at break even at a net margin of just 0.28%. But the good thing is that the company is already free cash flow positive with a free cash flow margin of 12.17%. Nonetheless, the investment thesis revolves around C Limited achieving profitable growth and improving profit margins in the long run. Now, I started my position on the stock at about $40 a share, so I'm up about 70% or so. But even considering the recent rally, I think the stock is still undervalued with a forward PE ratio of just 26 times and forward EV to sales multiple of 2.38 times. So I'm strongly considering adding to my position if we see further weakness, probably around the $60 region. That said, I have a price target of about $102 a share for C Limited stock, which is about a 50% upside from here, so still plenty of upside left in my opinion. Moving on to stock number 4 in my portfolio, we have On Holding, ticker symbol ONON, which represents 4.18% of my portfolio. Now, On Holding is quite similar to Lululemon because they are both in the premium sportswear category, but what On Holding specializes in is their running shoes, which has grown like wildfire over the last few years. As you can see, On has grown revenue at a 3-year CAGR of 57.61% despite a challenging macro environment with high inflation and high interest rates, and I think that is a testament to the company's brand mode and execution. Furthermore, the company probably has the highest gross margin in the industry at 59.87%, showing strong pricing power and high earnings potential for investors. The only caveat is its premium valuation. So as of this video, On has a forward PE ratio of 45 times and a forward EV to sales multiple of 4.58 times, which is much more expensive than its peers like Lululemon and Nike. However, the bull thesis on Holding is that the company will continue to take market share from legacy players like Adidas and Nike, and that it will be a much larger company in the future. And I think Wall Street as a whole agrees that On Holding will continue to take market share, which is why they are projecting revenue growth in the next 2 years at a CAGR of 27.69%. So for instance, On Holding currently has a market cap of 12.94 billion compared to 35.6 billion for Lululemon and 109 billion for Nike. So considering its growth momentum and market share expansion, it is not crazy to think that On Holding could one day be as large as or even larger than Lululemon. In my opinion, I think a $50 billion market cap within 5 years is very much possible, which is about a 300% upside from here. In addition, On Holding still has much more room to expand their margins. Currently, the company's net margin is at about 6.73% and free cash flow margin is at 14.44%. So for context, Lululemon's margins is about 16% to 18%. So On Holding still has room to improve margins possibly to 20% or more, and that's probably why analysts expect robust EPS growth over the next 2 years at a CAGR of 68.27%. So as margins continue to improve and earnings continue to explode, I think the markets will bid the stock price higher over time. As for me, I have a price target of $54 a share for On Holding, which is about a 30% plus upside from here. So looking at stock number 5 in my portfolio, we have Marqeta, ticker symbol MQ, which represents 4.75% of my portfolio. So Marqeta is a card issuing platform that allows enterprises to launch customized card programs like debit cards and credit cards that are highly scalable, configurable, and reliable. In my opinion, Marqeta is one of the most promising fintech companies out there because it powers some of the most disruptive customers, including Affirm, Square, Cash App, Afterpay, Klarna, DoorDash, Uber, Instacart, and more. And that is why I'm bullish on Marqeta because its customer base are some of the fastest growing companies in their respective industries. And as these customers grow, Marqeta will grow as well. As you can see, total processing volume or TPV by Marqeta has been growing like crazy, up by 33% in each of the last 4 quarters, which is really strong. Now, the stock's performance has been really poor, down 85% from its all-time highs, which has made valuation very attractive at an EV to sales multiple of just 2.64 times. But why is the stock down so much? I think we can blame two main reasons. One, the company is still severely unprofitable, as you can see right here, and with high interest rates, the stock is automatically punished. Secondly, Marqeta took a massive cut in revenue, down more than 40% in the last 3 quarters, but keep in mind that this was due to a new contract it signed with its largest customer, Block, where it affected Marqeta's revenue recognition. So, with the decline in revenue, I think a lot of uninformed investors might have mistaken it for something really bad that destroyed the company's top line numbers and fundamentals. However, gross profit, which is a much more important metric, has been stable even despite the drop in revenue. There was a slight dip in Q3, but again, this is due to the contract renewal with Block, which also reduced pricing, which is why gross profit fell a bit. But in the long run, I believe gross profit and revenue will grow again, especially in Q3 this year, where the Block renewal will be fully lapped. And besides, as you saw earlier, TPV growth has been really robust, which means that Marqeta is still growing. And when it reaches a large enough scale, I believe the company will drive profitable growth. But for now, I think the markets are very pessimistic on Marqeta stock. But over time, I think sentiment will change, and I think that will drive the stock price higher from here. Also, keep in mind that the company is already free cash flow positive with a free cash flow margin of 5.3%. In addition, the company has zero debt on its balance sheet with a net cash position of $1.2 billion, dollars, which is more than 40% of its current market cap of $2.6 billion. Dollars. I think that is just ridiculous, and I think it just shows how incredibly beaten down the stock is currently, which is why I think the stock will eventually turn around at some point in the near future. As for me, I have a price target of $8.49 for Marqeta stock, which is more than a 60% upside from its current price of $5.24. The next stock on my list is none other than the popular Palantir, ticker symbol PLTR, which represents 5.25% of my portfolio currently. If you're not aware, Palantir offers big data analytics and custom operational software solutions, helping enterprises integrate data, decisions, and operations at scale through its four platforms: AIP, Gotham, Foundry, and Apollo. Looking at the fundamentals, Palantir is a very solid company. Growth has been robust with a 3-year revenue CAGR of 24% and a 5-year revenue CAGR of 30%. And the company is expected to grow even further over the next 2 years at a CAGR of 20.77%. Margins are excellent with a high gross margin of 81%. Net margin is at 12.79% and free cash flow is at 27.48%. In addition, earnings per share is expected to grow at a 2-year CAGR of 25.8%. And the balance sheet is pristine with cash of $3.8 billion dollars with no debt at all on its balance sheet. So I think fundamentally speaking, Palantir is just really an excellent company. It also has a long growth runway given the big data and AI revolution. It has deep connections with some of the most important corporations and government entities in the world. It has arguably one of, if not the best software product for enterprises. Its AIP bootcamps are also taking off. So again, fundamentally speaking, Palantir is a very high quality company. The question is, with all these excellent numbers and stories that I just mentioned, is Palantir's valuation justified? Well, if we look at the chart here, Palantir is already up 70% so far this year, and as it stands, the company trades at a forward EV to sales multiple of 21 times and a forward PE ratio of 83 times. Now, valuation is a subjective topic, but in my opinion, I think Palantir stock is looking quite frothy right now. In fact, Palantir is the only stock in my portfolio where the stock trades higher than my intrinsic value per share estimate, which is $20 a share compared to its current price of $28 a share. With that being said, I don't plan on selling my Palantir position and I won't be buying here either. Instead, I will be looking to add to my position if we see the stock sell off to much more reasonable levels, ideally to my price target of $20 a share. But for now, I will continue to hold Palantir and ride the momentum. So, I just shared with you the bottom 6 positions of my portfolio, which are Enphase, Lululemon, Sea Limited, On Holding, Marqeta, and Palantir. And altogether, they make up about 22% of my portfolio. As for my top 7 positions, which are still blurred out right here, I will share them with you in a separate video. So if you're interested to find out the rest of my portfolio, be sure to subscribe to my channel so you won't miss future videos. With that being said, thank you guys so much for watching this video, and I'll see you guys in the next one.